Welcome to The Explainer. Today, we are digging into a really interesting question. Based on analysis from the financial platform Fundamental, is the U.S. economy actually heading into a perfect storm? Let's dive right in.
So if you just look at the headlines, you'd think things are fantastic. U.S. equity indices, the S&P 500, they're hitting one all-time high after another. It's exactly the kind of news that makes investors feel pretty confident.
But, and this is the big but we're here to unpack, how solid is the ground underneath all these record highs? Is this strength for real, or is it more of an illusion, something built on a foundation that's actually kind of shaky?
So let's start with Section 1. We're going to look at the cracks that seem to be appearing from inside the U.S. markets themselves.
A fundamental analysis called margin points to a big flashing warning sign, and it's called margin debt. So what is that? Well, put simply, it's money that investors borrow from their brokers to buy more stocks. It's like putting your portfolio on steroids to amplify your bets.
Right, so the margin analysis shows that this debt is hitting new highs right alongside the market. That means these gains, they're being built on borrowed money, and that creates a really fragile situation. A small market dip could trigger a huge wave of margin calls, which is just forced selling that can snowball into a way bigger crash. But here's the real kicker from the data. The big players, the institutional investors and insiders, they're selling. So who's buying at these highs with all this borrowed cash? Retail investors and corporate buyback.
And it's not just the stock market that's showing signs of stress. Another fundamental piece, this one called Case-Shiller, it's flagging a major shift in real estate. We've totally flipped from a red-hot seller's market, you remember, the bidding wars, to a buyer's market. Now, smart buyers can just sit back and wait for someone who has to sell, which of course drives down prices. And the analysis points out this is a classic pattern we've seen right before major downturns.
Okay, so that brings us to the next major stress point. This is a massive tug-of-war that's happening right now in Washington, D.C. between government spending and central bank policy. And to really get the scale of this, an analysis called Mo Money highlights something pretty staggering. The U.S. Treasury needs to borrow $1 trillion just for the third quarter. That's for 3 months of spending.
And of course, that's just one quarter. The same source, Mo Money, projects that the total U.S. national debt is on track to hit $40 trillion. To put that in perspective, that's 140% of the entire country's yearly economic output. It's just an enormous weight on the economy.
And all that debt is what creates this policy tug-of-war. Articles like Endgame and No Cuts in the Horizon describe how you've got these two giants pulling in completely opposite directions. The White House wants a weaker dollar and lower interest rates. That makes the debt cheaper to pay off and helps boost exports. But the Federal Reserve, it has a totally different job: fight inflation. And to do that, it has to keep interest rates steady, or maybe even raise them.
And this chart really shows you why the Fed's hands are tied. Analysis from the tariffs and inflation source shows that the key inflation numbers are just staying stubbornly high. If you look at that 6-month average, inflation is running over 3%. That's well above the Fed's target. So with all this government spending pushing demand up, the Fed has no choice but to keep its foot on the brake.
So we've got a leveraged market, we've got a domestic policy fight. The final piece of this perfect storm puzzle, well, it comes from outside the U.S. The global situation is so fragile right now that any little spark of conflict could have massive economic consequences. It adds a whole other layer of risk.
A fundamental brief called More Conflict gives a good example. It highlights a dispute between Thailand, a key U.S. ally, and Cambodia, which is a close ally of China. Now, this isn't just some local border dispute. It's basically a mini preview of the bigger U.S.-China competition. And for the economy, that matters because these proxy conflicts create instability, they threaten supply chains, and they raise the risk of a wider conflict that could send shockwaves through the global markets. It just adds a thick layer of unpredictability to everything else we've been talking about.
So, how do all these pieces actually fit together? We've looked at multiple really powerful forces, and they all seem to be converging on the U.S. economy at the exact same time.
So let's bring it all together. You've got a stock market that looks strong on the surface, but is actually fueled by risky debt. At the same time, the housing market is cooling down fast. You have the government borrowing money at a truly mind-boggling rate, which is forcing a conflict with a Federal Reserve that's just trying to fight inflation. And then, hanging over all of it is a world stage that's getting more and more uncertain.
See, each of these is a storm on its own.
And this brings us to a really powerful, almost biblical-sounding conclusion from that fundamental analysis on margin debt. It puts it like this. This market has been weighed, has been measured, and has been found wanting.
Which leaves us with the ultimate question as we wrap up this explainer. We've laid out all the pieces, all these conflicting forces that are pushing and pulling on the economy. So, with so much in conflict, what breaks first?